Today we're going to take a look at a smaller company that you probably haven't heard of. I certainly hadn't heard of them before we looked at them. In the last year, they've achieved a 60% return in value. In the last 2 years, it's 128%. In the last 3 years, it's gone to 288% return. So this is a company that's clearly on the move in terms of share price. Very interested to know how they're going to fare on our leaderboard, and also looking at the numbers. It's a company called Kainos. Knos is the EPIC code. If, like me, you are interested and excited about looking at Kainos's financials, then smash the like button for me, guys. Give me some support. Let me know that you're interested in the series that we're doing. It means a lot to me that people do that. Every time we hit 20, 30 likes, the views go up. So the more that you can do that for me, the better. We're going to take a look at Kainos. Let's dive in. Hey there, guys. Welcome then to episode number 13, unlucky for some, of the FTSE Show with me, Chris Chillingworth. What's the word when you say something really clearly? Chris Chillingworth. Extenuated? Not sure. I've done that today because people keep calling me Christian. So, I don't know why. My name is Chris, but I guess when I say Chris Chillingworth, everyone hears Christian, I guess. I don't know. But my name is not Christian. Anyway, we're going to take a look at Kainos, K-N-O-S. The numbers are looking really good. The charts look really solid. And I'm quite interested to kind of go through the motions, look through the financials of this company, and then score them at the end and see where they end up on here. I think they're going to do relatively well. They probably won't be top, but they're a decent company. They're a digital services company. I've read up on them. I didn't quite understand a lot of the jargon that's used, but they are digital services. One thing that I did pick up on was that they provide medical record software for the NHS as one of the many different things that they do. So in terms of volume of shares traded, 140,000 a day. Now, if you remember back to last episode when we were looking at British Gas or Centrica PLC, we were talking about 43 million a day, and they scored, as you can see, very, very poorly. Bottom of the leaderboard, minus 94 points. Here is a company that is traded far, far less, from 43 million a day to Kainos' 140,000 a day. People are not interested in trading this stock. And I see this all the time. The best companies to invest in are hardly traded, or many of them are hardly traded. And it's the high volume stocks that aren't the companies we should be looking at. And I guess this is why so many people don't make it when they try and invest. But anyway, enough of my waffling. Let's dive into the numbers. Okay, let's take a look at Kainos then. Kainos PLC, EPIC code KNOS, FTSE 250 company in the software and computer services sector. I've only got a few years worth of data because they floated in 2015, I think it was. But everything's looking pretty good on the revenue side of things. Every single year we've seen quite solid revenue growth, which is great. Cost of sales, as you can see, that's also been going up in tandem with that. The best way to see whether or not cost of sales is outweighing the growth in revenue is the gross margin percentage. And as you can see, the gross margin has been going down. So the cost of sales has been growing at a slightly faster rate than the revenue has been growing. So not a great sign, but the percentages aren't drastic. We can see, it's dropped from 53 to 45, so it's a decent fall in the slice of the pie that they're getting. The slice of the pie that they are getting is still 45% though. So that's really good. That's really solid. Almost 50% of the revenue coming in they're getting to keep after cost of sales deductions. So that's a pretty good start. Looking at the expenses are growing slightly, which again is not at the level that it's at is not a problem. So just shy of 70% of the gross profit is being eaten up by the expenses of running the business. That's healthy. That's fine. 70%, it's a lot, but it's within the kind of realms of what I would be looking for in a growth stock. But there is a trend there which looks like it's going up. So that's something that you want to be paying attention to. These expenses seem to be growing at a faster rate than the gross profit is growing. And so if that was a trend that continued, then we would probably see that having an impact on the profits of the business, and it could get out of hand. So it's something that you want to be mindful of, and it's certainly, in terms of using the clean score, it's not going to add them any, it's not going to do them any favours. In fact, it's going to give them some minus points in the overall score because of that trend that where the expenses are starting to cost more year on year. So the point scoring system does take trends into account, whether they're positive or negative trends in the data. Looking at the interest on debt, we haven't got anything to worry about there. Obviously not borrowing any money because we've got minus amounts here. We'll see that in a moment when we come and have a look at the liabilities. Net earnings, pretty solid, 16%. However, last couple of years that's been dropping. So again, we've got another trend in the wrong direction, but where they sit is still good. So my point basically being that the last annual report was 11.2% net earnings. That's good. You know, any company that's making 11.2% margin a year, profit margin a year, is doing pretty well. However, this downward trend from 16 to 11 is the concern. Will that trend continue in future years? Because if it will, that can hamper a growth stock. You know, when we're looking for growth stocks, we want the other direction. We want to see growth in the net earnings. We certainly don't want to be seeing it going down, having a trend going downwards. And so if that trend was to continue, eventually they would get to the point where we wouldn't be interested in Kainos in the future. So something to be mindful of. Again, it's going to take points away from their score. Let's take a look at the assets and liabilities. So current ratio, this is how much do the assets, the short-term assets, outweigh the short-term liabilities. They're at a nice and healthy 2.1 ratio, so double basically the amount of liabilities. So that's healthy, that's good. They're obviously, you can see the cash is growing, you can see the net receivables, that's the amount of money owed to them that's been invoiced out. That's all good, it's all healthy, no issues there at all. Property, plant and equipment is growing, but it's growing slowly, so they're not investing a lot of money in property, plant and equipment. That can be a good thing because that can help reduce depreciation costs in the future, because property, plant and equipment all depreciates, it all costs money, and it all needs replacing eventually. So a company that isn't investing heavily in that can often do very, very well. But assets have clearly been growing. Looking at the liabilities then, short-term debts, there are none, so that's solid, and long-term debts, there are none. So this is a debt-free company. They're not borrowing any money at all to achieve what they're achieving, which is great. Looking at the actual shareholder equity, that has grown every single year, so that's nice, solid growth in terms of the equity of the business. That is essentially the net worth. It's the assets minus the liabilities, and we've got absolute growth there, so that's great. Other thing I want to look at is the retained earnings. Retained earnings have been growing from 22 million to 39 million over the last 5 years. The average growth per year is 15%, so that's nice and healthy. It means that they're adding 15% more into their reserves every single year, and they've done that relatively consistently since floating, so that's good. I like to see that. And the return on shareholder equity, what return are they getting off the assets that they've purchased and they've invested in? What return are they getting on the investments that they're making as a business with the profits that are being left over? And those percentages are good. There has been a drop-off, but it's still well within the solid region of what I would be looking for. So the message here, I suppose, is that there are some trends going in the wrong direction, but we're still well within a zone of these are really good numbers. That's the kind of underlying story here. So that's all we've really got to look at, and it really will come down to the score. Bottom line is this is a good company. It doesn't stand out as something that is particularly exciting to me. The negative trends that we see are what would put me off from being an investor, but they are decent. And if you were to invest in this company, you probably do well. If you were to invest back in 2015, 2016, you probably would have made some decent return. This is not a company I would invest in because of the negative trends. That's simply it. The position that the business is in as of 2019 is still fine, but if this negative trend was to continue, then there'd start being some issues, and so therefore, for that reason, they're not a company that I would personally be looking to invest in. Let's take a look at the chart. Okay, so this is all we've got. We've got from July 2015 to current day, and clearly there's been some solid growth here. And this is testament to the numbers. When you see green numbers like that, when they're ticking the boxes of what I'm looking for in a growth stock, I very rarely see a falling chart. Let me explain that in a different way. When a company is ticking all the boxes financially in what I'm looking for, these are the sorts of charts I see. Obvious growth in share price over a period of time. And had you looked at those numbers and said, yep, they tick all the boxes, I'm going to invest, and had you done that in sort of 2016, 2017, you would have done pretty well, right? I mean, looking at this, 2017, about £2 a share at that point, now at £7.78 a share. So it's decent growth. It's what we're looking for over just a handful of years. I'd be pretty happy with that as an investor, as a trader. And the issue here now is with those negative trends in the numbers, will this stock, this share price start to flatten out and not continue to grow? That would be my concern. And so, again, it comes down to when you've got a certain amount of capital and you've got thousands of shares to pick from as where to put that capital into, Kainos is a decent stock, and if you were to invest in it, you'd probably do well. You certainly would have done well over the last couple of years. But there are better companies out there. There are companies with far more impressive figures, with the trends going in the right direction, for you to put your money into. And so you could put your money into Kainos, but it would kind of be illogical when there are better options out there for you to invest your money that have better odds of producing bigger returns over the next 5, 10, 20 years. But still a decent company, still a decent business, still a decent investment, and far greater than some of the faff that I know a lot of investors put their money into, like Centrica, like Tesco, like BP, where you're really not going to get anywhere. But with a company like this, over the next 10 years, you might do all right. So let's take a look and see how they scored and where they're going to end up on the leaderboard. Okay, so much better numbers with this company than Centrica, British Gas that we looked at last time. It's nice to find a company where the numbers look a bit more exciting. They didn't quite make it. They weren't quite solid enough for me in terms of taking them on board and putting them in my portfolio. I am very particular about the quality of companies that go into my portfolio. Of the 160 that I've analysed over the last year or so, only 29 have ever made it through. So yeah, the bar is very high. But Kainos still a solid company, and looking at those numbers, you could do much worse in terms of your stock picking. So let's get them up on the board. So finally, it's been a while now, hasn't it? I get to use the black pen. That means it's not a minus number, which is, it's nice. So Kainos, Knos is the EPIC code. They scored a rather respectable 57 points. So that puts them fourth. Let me just chuck it up on the board. And there we go. So not quite so strong as Intertech or Bodycote or Taylor Wimpey, but still up there. And a respectable score of 57. It kind of sits in the middle, really. I'm looking for companies that score well over 100, ideally. Sometimes in the top 90s, I might be interested. But 57 for me, not quite high enough a score, but still decent. So yeah, interesting to see how it's all playing out. We've got 13 companies now on the leaderboard, and as we go through more and more and more, it's going to be interesting to see if anything else can tackle or chase Taylor Wimpey at the top there. I don't think we're going to get anything propping up the leaderboard again. I think Central are going to be down there for a while. I might be wrong. We'll see. But yeah, Kainos, 4th place at the moment. Decent. Guys, before you go, I just want to say thank you so much for checking out this video. If you have enjoyed it, please smash that like button. Please subscribe if you haven't done so already. And leave me a comment if you've got any questions, any input, any suggestions, any companies you'd like me to take a look at. Whatever, I'm open to anything. So, but thank you very much for checking it out, and I'll see you guys in the next episode. Cheers.